Good afternoon, everybody. It is Monday, October 11th, 2021, and we're starting out with retirement income options today. Just wanted to show you a couple of new articles that I'm putting together that will be the main pieces here going forward to make it much easier to follow along with the options and make those trades yourself. You asked for a little bit more hand holding, a little bit more direction. So I'm going to give it to you. And we're going to start with a position tracking article that I will update once or twice a month, and it'll have all of the trades in here. I'm going to fill this in going back to the start of the year. I've been going through the articles, and you will be able to see what we're trading, what the option is, opening date and price, closing date and price, results, and some notes. And so I think this will be very, very helpful to those of you who are trying to follow along and trying to make these trades yourself. So here's one that's going to expire on Friday, Amidas, October 1250 put. And where I can, I'm linking the articles that the recommendation came from, and it'll be easier with the new format that I'm putting together. So this is going to expire with a $1.50 premium, just falling to your bottom line. So in about 6 weeks, actually probably closer to 5 weeks, you could have made 12% on that portion of your money market money. Pretty nifty. A bunch of these are coming up. We'll see if they expire. I don't have any closing orders on these right now. Here's some other ones. No closing orders so far. Handful of covered calls you'll see. And these are mainly from that article where I talked about large caps being where the most risk was. AST Space Mobile, I have a call because I had some puts put to me and my position grew too big, so I managed the position. This is probably going to expire because AST Space Mobile is down around 10. In fact, I could probably close this. I haven't because it's a call and I'm okay with it getting called away. But if I wanted to take a profit here, it's down to around $1, and we could do that. So when we take a look at the screener on TradingView to try to figure out what we should be writing covered calls on, this is just the S&P 500 here, and we rank it by relative strength index on the weekly. The weekly charts are what we want to use, and we can see that as opposed to about a month ago, there is a lot fewer overbought stocks on the S&P 500. If you'll remember, a month ago, there was like 100 stocks up around 80 and maybe 200 that were in the 70s. So you had a lot of overbought stocks on the S&P 500. That's gone away. That has largely happened as the little teeny tiny correction has played out. But if you pull up any of these companies, let's take ConocoPhillips, for instance, what you see is that the energy stocks largely all look like this. This is something that if you owned it, I'd say write a covered call. It is overbought on the weekly, and that sure does look like a spike. I would probably say trim it because look at that, look at that, look at that. If this doesn't break out past here, then you probably have a pretty good trend line to the downside redeveloping. So you're getting your big rebounds because that's what energy does. You're getting your another setup chance to sell this off. The odds of this breaking out in the face of the Fed tightening, strategic petroleum reserves just sitting there ready to be tapped, China already using their strategic petroleum reserve, I don't see a lot more upside to oil. Not that it can't hold on for a while, just on tighter supply demand. But as we've discussed before, an awful lot of people need to make money on oil, so they're going to want to try to increase their volumes. And they don't want to cause a recession. We know that the oil producers know that they can't have oil too high, otherwise they hurt economic growth, in which case they lose volumes and price. So I'd expect OPEC next week or 2 weeks, whatever it is, their meeting is coming up, to probably add just a little bit more oil to the market. But that's what this is really good for. You go through here, you see that our stocks in fertilizer, of course, we don't own this one or this one, but we own Nutrien, and Nutrien has been one of my favorite stocks for what, 2 years now. So that's done pretty well. It was one of my picks last year. I can live with that. Double on a dividend stock. So the options that we have open, you can follow along right here. And then the new article is going to be updated for the plug and play. And it will include conviction trades. So that's what will go in this area. And I will have that up and running for you as I go through these. I'm going to update this entire chart all the way down and added the global trends ETF. So between the weekly technical charts and some conviction trades across our 50 some focus stocks and another dozen or so ETFs, should make this super easy to follow along each week. You don't have to try to figure it out yourself. I'm just going to give you 3, 4, 5 ideas every week, and you can jump on those. So if you ever want to see equity option price history, this is one of the neatest features over at Bar Chart. You can't find this everywhere, where they will give you the price of a specific option daily, the open and the last and the high and the low of the day, including the volume that day and any open interest. Take a look at some of our stocks and some of the ones that I track on the oil side. Continental, I could see you writing a covered call or selling it all. Same thing with Conoco. Again, when you take a look at these charts, really just take a look at the last year. That's a heck of a rally for a company that was essentially bankrupt. So the fracking boom, right? Big fracking boom comes off, rises, comes off, rises, crashes down way before coronavirus. And that's just the final straw here. And now you have this big rally, which is probably due to OPEC manipulation and then in QE. So again, I'd ask you, if you're really into oil, does it make sense that this is going to keep going up? Or does this trend look like it'll keep coming down? And this is just a rebound rally in a long, painful death. I wanted to take a look at the S&P 500. And one of the things I'd like you to take a look at is this bad pattern that's developing. You know, we talk about Elliott Wave being able to kind of take a look at the big things that are out there, and it gives you a general idea of just the ebb and flow of emotions among traders. Mathematically, there's nothing special about it, but if you add all the things that I add to it, mainly the money flows and the volume, the price weighted volumes, you can see where the big interest lines up among the value buyers, providing support. And you can see where selling accelerates based on, oh my God, it's below where I bought it. I better sell it before it goes lower. So S&P 500, remember this period, took a very long time, 13 years, get back from the 2000 peak. Didn't happen until way over in 2013 on the S&P 500. And this is adjusted for dividends, so that counts. In the age of QE, we've had a lot of rallies, volatility events in 2018 that I forecast, coronavirus crash, and now this huge QE infinity rally. So I'd like to ask you, there's a couple different ways to look at this shape. Let's presume the coronavirus wasn't going to happen. Just imagine it away for a moment. We get the big rally. That's a 1, 2, 3, 4, 5. Then you get a correction. If this was what was called an ending diagonal. I happen to believe that there's a very good chance that we are in the middle of an ending diagonal. What is that? Elliott Wave suggests this. Rally, fall, rally, 3 waves up, double AV there, bam, correction. That's one thing that could be happening right now. And we won't know until really this next move in the market. That's how kind of we'll probably know what's going on. There's another thing that we could consider. Maybe this was the start of the new bull market. Maybe this was all an ending, and this is the start. And this is why Elliott Wave is hard, because until you're halfway into it, you don't really know, did you start something new or are you just finishing the last thing? And that's why when you listen to an Elliott Wave analyst, a lot of times they will say something and then have the caveat, unless it's this. And that happens over and over and over again. And that way they can claim they're right, because they said, well, they're covering 2 out of 3 bases, because there's usually really 3 outcomes, and they'll cover 2 out of 3 in most cases, and that will cover it, probably 5/6 of the time. So if they give you the thing that's 50% likely, the thing that's 1/3% likely, they don't have to bother telling you the thing that's 1/6 likely. And that's kind of how it really goes, actually. But let's suppose this is the start of the new bull market. 1, 2, 3, 4, 5, splat. We could be in this type of pattern where at some point the S&P 500 gets real close to these levels again that we saw near the bottom of the coronavirus crash and the 2018 volatility crash. This is the first sell vol crash, and then the end of the year. So could we end up down in here somewhere? Possibly, if it's a megaphone pattern. And I've talked to you about megaphone patterns before. Here's the problem with all these long-range forecasts. A lot can change. And that's the problem, which is why I just focus on what I can know, which is pretty much how a company is managing itself and how well their markets are doing and how they're positioning themselves in their market and what they have as a relative strength advantage, what they have as a moat. These big forecasts are usually wrong. If you take a look at any of the forecasts from year to year from the investment banks, they're pretty much all wrong. You'll get 1 or 2 people who got it right a particular year. And maybe if they get it right twice in 10 years, they're anointed a superstar. These forecasts that are longer than a year or 2 are just remarkably bad. Why? Because there's just too many things that can happen. Too much randomness in the markets. But there are certain things that have correlation to the same things happening over and over again. And the one that I've been talking about is this. When the Fed tightens, there's always a correction. It's only a matter of magnitude and duration. If I had to guess, unfortunately I don't, because I just try to pick out good companies and stay in the right sectors, I would say you're probably going to see a pretty good correction here going into the end of the year or early next year as the Fed tightens. Because right now, everybody's spazzing out about inflation because, oh my God, supply chains are messed up. That must mean hyperinflation. Inflation is running at 5% right now. That's not hyper anything. That's making up for 4 decades of low inflation. That's all that is. Problem is that unless you're an asset owner, you're getting beat up. And still to this day, people are choosing not to go back to work. It's almost like a gigantic wildcat strike, from what I can tell. When you have 10, 12 million people just not going back to work, you really have to shake your head and wonder why. Are they all lazy? I don't think that's the case. I think there's a lot of being fed up with not feeling safe, not feeling appreciated, not feeling like you had a real role where you were affiliated. These are all concepts from a book called Beyond Reason, which I would encourage you to read. People need 5 things in life. They need autonomy. They need to be appreciated. They need to be affiliated with something. They need a role with that something. They'd like some status. Those 5 things: affiliation, appreciation, autonomy, role, and status. Beyond Reason. Read the book. It's from the guy that helped negotiate peace between Israel and Egypt. Probably knows what he's talking about. Looking for win-win situations. And right now, in the American economy, we're not quite having a win-win equation because most of the wealth is still flowing uphill. And I'm telling you, my conversations with people in Milwaukee and several other cities, a lot of teachers in particular who are quitting, they don't feel like they're appreciated. They don't feel like they have a role in where they work anymore. They're just being told what to do, which means they don't have any autonomy. They don't have any status. There's a lot of disrespect in the American economy right now. And I think a lot of people are taking it out on the system. If they can get by without working, they're doing it. And then there's this other thing. For years and years and years, I remember people saying, well, it'd be nice if both parents didn't have to work? Well, I think in a lot of households that were able to get ahead, that's happening. I'm seeing that. I see that among friends. I see that all over the place. I read about it. Go to the Atlantic, go to Wired Magazine, go to the New York Times, read the interviews with people. Why aren't you working? And a lot of times it's just, hey, I don't think I need to right now. I don't like what I was doing. I'm not ready to do something else. And we're getting by on the one income. And probably something that nobody wants to talk about is we don't have immigration right now. I mean, we're so bad at bringing people in on work visas. You've got literally thousands of people at the border who would take the jobs that are untaken right now, and we're not letting them take those jobs. So where are we at with the economy? A very short-term burst of inflation into a long-term deflationary trend. It is cyclical inflation into secular deflation. The article I wrote earlier in the year about inflationary policy to fight long-term deflation is being complicated by a shift in supply chains that we asked for. We asked to bring the supply chains back to America. We're in the process of. That's why I'm so high on Intel. They're going to be one of the major beneficiaries of semiconductor fabrication coming back to the US. They're probably going to end up having a pretty nice run, similar to the one Taiwan Semiconductor had. So when you consider all the moving parts, you say, okay, yeah, there's probably more correction coming. Maybe it's minor and it gets up to the round shiny number that I've been talking about since way back here, since that conversation I had with Mark Yusko. I've been talking about 500 on the S&P 500 for 5 years. Does it get there or not? I'm not sure. I don't know if that's the next thing that happens. It might. If it doesn't, this area in here, and we've talked about these trend lines. See the two blue lines? It depends on where you measure, which peak and which trough. The green line, the green channel, is basically your QE channel. So if you believe QE is forever, and I'm thinking it's at least for a long time, we're going to stay in this higher channel until QE starts to go away, which might not be until after the retirement crisis later in the decade. This red line, more representative of a normal channel that we've had a much longer term, but that we seem to be breaking out of. So how far down do we come down? Hard to know. Do we go back to the old channel? I don't think soon, but there's this area that's overlapping. And I think that's probably where the correction comes. My guess would be just inside the top of the first channel, smack dab in the middle of the higher channel. But again, sort of, who cares? Really, who cares? If you're picking out good stocks that are going to have less correlation to the stock market, and whenever the next rally starts, people will start going, okay, hey, look, we're early rally cycle. Let's go find the small caps. Let's go find the high growth companies. And then, by the way, your QQQ stocks. It happens over and over and over again. So wherever this correction gets to, and whether it's this fall or next year, the whole strategy is selling the puts when things are oversold or close to oversold on the weekly chart, and selling the calls when they're close to overbought on the weekly chart, usually going to work. Remember, it's rare that we get overbought or oversold on the monthly chart. So if we take this right now, we see that we got overbought. And right in here, I said that's a guarantee of a correction, and we got a correction. Now, will it bounce back up here a little bit before it continues down? Probably. That's the wavy way for things to happen. If you take a look at the monthly, still pretty overbought. So if we get a little rally, all that is setting up next decline. So if we get a rally here into the end of the year, which we might ignore the Fed for a while till liquidity dries up. My guess is not. I think the rally that we saw today is probably pretty short term. But again, I don't think there's a way to predict it. You can listen to somebody say 3 different things. It could be this, this, or this. Who cares? What you need to know is, what is your risk tolerance? Do you want to try to get one last puff on the cigar if we rally up to 500 on SPY? Or do you want to create streams of income selling options? This would be about a 15, 16% rally, 17% rally. If it happens, If you're selling options, you can probably still make that return and have a margin of safety between you and the market of somewhere between 5 and 25%, depending on what you're trading options on. And again, I'm not saying buy any options. If you don't understand the difference between buying and selling options yet, you shouldn't have an opinion. You should just say, I don't know what you're talking about. When you sell options, you're the house, you're the insurance company, you're not the speculator. And that very simple ebb and flow trading using the weekly RSI has been remarkably effective. And that's why I'm putting this together for you. So you can see exactly how it goes down over a period of time. I'm gonna go all the way back to the start of the year. And then you can follow along with the potential trades and the conviction trades. And the conviction trades will be the ones that end up in here. So I strongly recommend, again, that if you don't know how to sell options, but you say that you're a dividend investor, you're missing half of the boat. I've shown you example after example, where you can sell an option one time on a company and essentially double your dividend. Imagine if you do it 2 or 3 times a year. So I've said you can generally grind out around 10% income with a pretty middle of the road option selling strategy that cuts your risk against the market, between 5 and 25%. I mean, that's a pretty nice way to make a return. How many of you would be brokenhearted if you made around 10, 11, 12% income on your portfolio, a couple points in dividend, and then around 10 points selling options? And you're going to capture most of the upside with some safety against the downside. Not tons of safety, but it'll still be less risk than the S&P 500 in general, because you're collecting premiums and you're setting strike prices that are a little bit below current price and looking at a stock or an ETF. So I don't want you to be so enthralled with the big macro calls, because they haven't mattered that much ever, unless in the QE era. You just have to understand what are the truly big things that could happen that are bad for the economy. Inflation's not one of them. Inflation hasn't been a big deal in 40 years. It's not going to be a big deal in 2 more. And as I discussed with you in chat, I was just at a shipyard up in Sturgeon Bay, Wisconsin. That whole city, which was laid to waste 15 years ago, is actually really well built up now. 2 entire streets of shops and restaurants, a couple blocks away from the shipyards, where there was a whole row of ships getting built and repaired. A brand new gigantic building for building indoors during the winter. Help wanted all over the place. There's going to be plenty of ships on that water pretty soon, because they're taking an awful lot of ships that weren't seaworthy and making them seaworthy. And there's new ships being built. In most of the places where you unload, and I saw one of the giant container unloaders, because they have one up there in Sturgeon Bay, they're pretty automated. So I can't imagine that once people start to need money, which is probably imminent, they can't fill these $30 and $35 an hour jobs that pay overtime and are unionized with good benefits. If for some reason the inflationistas are getting you to believe that inflation's coming back after 40 years, that it's somehow going to be persistent, let me know in chat and I'll give you 10 books to read. And it's just not going to happen. Or listen to the Federal Reserve Chairman, and even more, listen to Janet Yellen, Ben Bernanke, Neil Kashkari, Mohammed El-Arian. Kashkari's a Republican. Kashkari is a nothing, I don't think. Larry Summers, clearly Democrat. The point is, so the best economists in the world are telling you this inflation is short-lived. Goldman Sachs just came out with a report saying, hey, inflation is about to slow down because growth is about to slow down. Or maybe it's growth is going to slow down and then inflation is going to slow down. Who knows? Causal, correlated, who knows? At some point, who cares? What we do know for our investments, though, that the large cap stocks that have been bid up and a lot of the dividend stocks that have been chased up are in trouble. And a lot of the stocks that have high leverage and high call volumes are in trouble once liquidity starts to get a little bit tighter. And I don't think it's big trouble, but it's enough to have at least a partial reversion to mean. And then what do we know about the Fed? Well, at least this Fed chairman, and if he's still the Fed chairman in February, tends to change his mind. So they might tighten from November to February or March and then stop tightening. They may never get rid of the QE altogether. That's actually my prediction. I don't think they get rid of the QE. I think they flatten it and then they start adding again. And I think that this is a rinse and repeat cycle until we either have the retirement system crisis 5, 6, 7, 8 years out, or they preemptively solve for it ahead of time, which Senator Manchin clearly doesn't want to do. And again, all these macro things, how does that affect my investments? What has Warren Buffett told you? Just pick out the companies that have moats, have high growth in front of them, and that are unappreciated by the market. I read a tweet from a guy who's been in the markets for 35 years, multi-millionaire, might be a billionaire. But he said, you know what I do my whole career is when something was in shortage, I bet the other side. When something was abundant, I bet the other side. So he said oil's about to fall because everybody thinks the opposite. I just always took the other side of the bet. Oil went from 0 to 90 or 0 to 84, whatever it is now on the Brent side. If you were going to bet on oil, wouldn't you have done it a long time ago? But if you were going to bet on oil and bet on alternative energy instead, you would have made a lot more money. I showed those charts too in the last article, in the last macro dashes. If oil does well, alternative energy does better. It's just the way it is. When oil does poorly, alternative energy does less poorly. It's just a better investment. So if you flip this over, we can see AT&T hugely oversold on the weekly. Bristol Myers is interesting. On track is still attractive. Right? What if I told you when stocks are down 70, 80, 90%, you only ask one question, are they going to stay in business? And if they are, buy them. On track is in that group. I don't know who's Macri Infrastructure, again, hugely oversold. Kind of curious about this one, aren't you? Oh, did they get bought? Something happened. I don't know what happened. May have to look that one up. My guess is some sort of M&A event. Something happened. Come on through here. People were asking about Zoom, so I pulled up the Zoom chart. Back when Zoom was way up here, I told you price 200-ish. Remember that? That was January or December last year. I told you that Zoom was going to have a tough year in 2021. In May, I said this. They kept coming down. Closer to $200 a share. That's what I'm telling you. So if it gets into the low 200s, up around here, then we have to see what the momentum is at the time. Has it started to chop along? In which case it's probably a buy. Does it do a couple jitterbugs and then it start to fall again? If so, price in the 120s is very interesting to me. I don't know that it can get to the 120s. This seems to be pretty big support here, so maybe a price in the 170s. If I had to put a bullseye, I'd put it about here. I'd probably put it about the end of March. Something's telling me this correction goes to the end of March. That'd be my guess. Based on the volume analysis. This seems to be where a lot of people got interested. Right in here. I think most of them are smart enough that they're not going to panic sell. So once we get through this area of selling, which is not marked by a lot of people, probably get the same old people bought over here, and they've probably been selling. They probably buy it back again down here. Interpretation of these volume bars is pretty important, especially when it comes to retracements and where the big support is. Look at that, right? Huge developing support, and it's probably a little higher now. So don't jump the gun on Zoom. Still like the company. We're using it right now. This is a pretty strong trend, and it hasn't started going sideways yet. And I looked, there's not really any particular activity on Reddit. So not a Reddit army stock that's going to suddenly, go ape on you. What did you ask, Tom? I think the rolling corrections run through March because they'll coincide with a rough first quarter. First quarter is usually the bad quarter for the economy. And March has usually been the month that reflects it because you get the early announcement, the pre-announcements. And then April comes and everybody's been talked off the ledge and the CEOs manage expectations. And I don't think that the Fed is going to keep following through on tightening up because as the supply chains move, right, as time heals things, as the midterms come up, I just don't see some gigantic bear market developing. The rolling corrections have been going on. Over 90%, it's like 92% of the stocks in the S&P 500 have had a 10% correction, and it's almost half have had a 20% correction. So you look for the rolling corrections. That's why you keep your list, and you just let the stocks come to you. All the people who get excited about trading and chasing, again, even the professionals don't trade much of their account. Very few people who trade most of their money. Shooter trades like 10% of his money. I trade between 10 and 20% of my money. And usually closer to 10 on the swing trading. I just do a lot more of the ebb and flow option selling, which I don't think of as swing trading. I just think of it as ongoing premium collection and risk mitigation. Swing trading, you're trying to hit home runs. So that's like a dime on the dollar. But understanding these longer term trends, right? You got to try to pick out every little zigzag here. That's really hard. But this is much easier to see, isn't it? This is easy to see. And again, for whatever reason, the Fibonacci's, something about them being natural numbers, make them work-ish. So there you go. All right. Any particular questions today? Any particular stock you want to look at? AT&T? Tell you what, my analysis is that AT&T is around 130 to 140 billion dollars undervalued. That means that based on the current market cap of around 160, 170 billion, it's basically a double from here. And I think once the separation of Warner into Discovery is completed, they actually announced the symbol it's going to trade under too. It's going to trade under like WMB or something. Or WMD. That would be funny. Is it WMD? I don't remember what the new symbol is. But remember, if you're an AT&T shareholder, you get 71% of that new company. And Discovery is worth about $13 billion, and I think that's half price. I think that Stone Company is in a great spot. I just think that it hasn't had the attention of the public, but it's getting back to the price where Warren Buffett bought it, where his guys bought it. So unless Berkshire dumps on it and there's something that I'm missing, fintech in Brazil is going full force. And Brazil is really gravitated towards fintech. I think that Stone Company is incredibly attractive longer term. If you pull up the chart, take a look at the weekly, right? Hugely oversold. Hugely oversold. If you want to live in day-to-day land, it's a little different, not much. Take a look at the monthly, right? Could still go down a little further, it could. But again, remember, things don't get oversold on the monthly very often. They usually don't become more oversold than they've been. So could go down a little lower, it could, just because Americans aren't interested in it right now. But at some point, remember, institutions and funds just start buying this stuff up. Warren Buffett's got a lot of money. Look, it's basically almost where he bought it. So I'd be buying this one and selling puts. In fact, this will be one of our conviction put sales. I don't know why people would need to ask about Spire Global and Ginkgo Bioworks week after week. The story hasn't changed. There's nothing different about them. Everything that I wrote about them is right. It just doesn't change in a week. One ETF that I'm pretty interested in right now is EMQQ. I think that there's one more leg down. But if you take a look at the Chinese stocks, which represent like 60% of this thing, they look like they could be coming close to a bottom. So again, I think this is the right buy zone. Does it get to 40 or does it, hold on to 50-ish? I think it probably gets into the 40s. I'm not sure where. Now, there's a new fund called FMQQ, brand new. It is the same as EMQQ without the Chinese stocks. So EMQQ and FMQQ, same company. FMQQ is EMQQ without the Chinese stocks. So there may be some ways of trading those a little bit longer term for when we want to be heavier China and when we don't want to be heavier China. Or when we don't want it to be 60% China and 40% the rest of the world, we can add some FMQQ to maybe flip that to 60-40 or make it 80-20, however you want to balance it. Or you can use FMQQ and KWeb, which I'm going to talk about. So I'm writing a whole article about this. If you don't want to use EMQQ, you can use FMQQ and KWeb and trade them separately, because KWeb plus FMQQ basically equal EMQQ. And that actually might be the way I end up doing it in accounts where I can trade a little bit more. In accounts where they don't like to see movement, I'll probably use EMQQ. So again, I would look up S&P 500 megaphone pattern. Just go on to Google, S&P 500 megaphone, SPY megaphone, and you'll see dozens of these charts out there. And these broadening top patterns usually have a bad resolution, usually. But I wonder, right? He predicted it. This chart goes back a long time, right? Predicted it happened. Now, again, was that because of coronavirus? Or was it going to happen anyway? And you know my opinion. I think it was going to happen anyway. I think maybe the only thing that changed was the time frame. So we'll see where that goes. I think that we just did this. We're about to see that. And again, a quarter or two in either direction in the big scheme of things isn't that big of a deal. That's why price matters. That's why understanding the companies that you're in matters. And that's why understanding the real macro picture matters. Because if you're still married to the idea that inflation's a big deal, you're wrong. Just like everybody else has been wrong about that for 40 years. All right, have a good night. Unfortunately, the Brewers are down 1-2. I'm not feeling so good about the fact that they can't hit. So hopefully we still have Brewers baseball in a week, but I don't know. We'll find out Friday morning, right? Thursday night we'll find out. So I'll tell you all about it Friday morning. Not feeling as good about it as I did about the Bucks when they were down and I said they'd still win it in 6. All right, have a good night.